Welcome. In this video, I will explain the price to earnings ratio to you in 5 minutes. This is Max. He just had his first ever finance and accounting lecture and now he wants to invest in the stock market. He looks up some financial data of companies he knows. Unfortunately, there's way too much info, making him feel very confused. Luckily, he knows Anna. She already completed that course and shows him a simple metric to evaluate a company's share, called price to earnings ratio, or just PER. So what is PER? PER is a company's share price divided by its earnings per share. The result is a multiple. It gives you information on how much investors are willing to pay for a share relative to how high the company's earnings are that you buy access to. Let's look at an example. BMW's share price is at 84 euro and it generates profit of 4 euro per share every year. That would result in a PER of 21. Meaning, if you bought that share, you would pay 21 times the money it would produce in earnings per year. So it would take 21 years to get back your 84 euro you paid for the share. So, is 21 a good or a bad ratio? That depends. You cannot look at just one PER in isolation. It is only useful for comparing shares. Let's compare BMW's PER to another company's PER, General Motors. The GM share costs only 36 euro. The earnings per share are also lower at 2 euro. That means the GM share has a PER of 18, which is 3 euro less than the PER of BMW's share. So at the moment, the GM share is cheaper than the BMW share, factoring in the earnings per share. Another useful comparison could be comparing General Motors' current PER to its PERs from previous years. This way you can assess whether its PER is rather low or high at this moment. So you can compare PERs like supermarket prices that are standardized to 100 grams or 1 kg. Exactly. It standardizes the share price accounting for the earnings per share. Let's compare the PERs of General Motors and Amazon. That would not be a very good comparison, and that is also one limitation of PER. You should really compare company shares from the same sector. General Motors is in the automotive industry, while Amazon is a tech company. These sectors are different in influencing factors like higher growth rates in the tech sector. This can lead investors to be willing to pay higher prices for shares because they expect growth in the future. And this will increase the PER. Sticking to your example, it would be like comparing the price of 1 kg of potting soil to the price of 1 kg of rice. They are two different things. Should I always buy shares with the lowest PER? It is not that simple. A low PER can be due to many reasons, like a company's business model is deteriorating and may not be profitable in the future. On the other hand, if growth is expected, a share can be highly valued, which increases the PER. PER is a handy tool to quickly assess a share's current value. But to make informed decisions, you should analyze the company's business model within the context of the sector. Max now knows a little bit more about how to evaluate shares and will use PER as a metric for first assessment. I hope you will do the same. Thanks for your attention and have a great day.